Welcome back to our Mortgage 101 series. Today we're breaking down key mortgage terms, principal, interest, term, amortization, and payments with simple examples based on a $500,000 home. We'll also show how different down payments, 5%, 10%, and 20% impact your mortgage. Principal is the actual amount you borrow from the lender after your down payment. For example, on a $500,000 home with a 5% down payment, you're borrowing the remaining 95%, plus CMHC insurance in some cases. Interest is the cost you pay for borrowing that money. The higher your principal, the more interest you'll pay over time. The term is the length of your mortgage contract, typically 1 to 5 years. At the end of each term, you'll either renew or renegotiate your mortgage based on current market rates. Amortization is the total number of years it will take you to fully repay your mortgage, most commonly 25 years. Payments are the regular amounts you pay to the lender, usually monthly or biweekly, covering both principal and interest. Now let's look at how your down payment impacts your mortgage amount, insurance, and monthly payments. Scenario 1, 5% down payment. Down payment, $25,000. Mortgage amount, $475,000. CMHC insurance, approximate 4%, $19,000. Total mortgage principal, $494,000. Estimated monthly payment at 5% interest, 25 years amortization, around $2,867. As you can see, with 5% down, CMHC insurance is required and becomes part of your mortgage amount. Scenario 2, 10% down payment. Down payment, $50,000. Mortgage amount, $450,000. CMHC insurance, approximate 3.1%, $13,950. Total mortgage principal, $463,950. Estimated monthly payment, around $2,693. With 10% down, your insurance cost drops and your payment is lower compared to 5%. Scenario 3, 20% down payment. Down payment, $100,000. Mortgage amount, $400,000. No CMHC insurance required. Estimated monthly payment, around $2,326. With 20% down, you skip insurance altogether and enjoy the lowest monthly payment. Now let's talk about something many homebuyers overlook, the opportunity cost of waiting to save a bigger down payment. Let's say you decide to wait 4 years to save $100,000 for a 20% down payment. In that time, home prices may rise. That same $500,000 home could now cost $620,000. Now, 20% down means you'll need $124,000 instead of $100,000. That goal just moved further away. And during those 4 years, you may have paid tens of thousands in rent, money that could have gone toward your own mortgage and equity. Meanwhile, others who started with just 5% down may already have 4 years of equity and appreciation built in their home. This is the real cost of waiting. Sometimes it's better to start early, even with a smaller down payment, and grow your wealth through ownership. I hope this example makes it easier to understand how mortgages really work. In our next video, we'll explore how amortization periods affect your total interest and payments. Thanks so much for watching this Mortgage 101 video. I hope this gave you a solid foundation and made mortgages a lot less confusing. If you've got any questions, drop them in the comments. I'd love to help. And if you're ready to take the next step, feel free to reach out. My contact info is right here on the screen. Don't forget to like, subscribe, and share this video if you found it helpful. See you next time.